Good morning, everybody. It is Friday, April 3rd, 2020. Kirk Spano with Fundamental Trends, Margin of Safety Investing, and my investment firm, Blue Mound Asset Management. And we are still in the midst of the coronavirus crisis, and we are getting to some important inflection points that will give us a clue in the next 2 to 4 weeks how long this is all going to last. I'm not overly optimistic, but I'm not overly pessimistic. I think that we beat this. I just wonder if we started a month or two too late to do so, and if we're going to have to battle it a little bit longer. My guess is that we do, and it seems like there's some pretty important people lining up in that direction. So I have showed you the curve at the Johns Hopkins website. Logarithmically, we had an expanding curve. As this curve bends up, that's bad. As the curve bends down, that's good. And we are at a point right here where we have to find out, now that we have a lot of testing going on, is this curve going to bend up or is it going to bend down? And it is necessary for it to bend down in order for things to get better. If it bends upwards, then we are in big trouble. And that means that we will have to definitely do a very, very significant crackdown on anybody moving around. And this morning, I was watching Nancy Pelosi on CNBC, and she had a message for the population that I think she couched, but it was clear. It is very likely that these stay-in-place orders, shelter-in-place orders, stay-at-home orders, whatever you want to call them, stay in place past April 30th. That has not been announced yet, and it is not something that I think most people expect. I think most people think April 30th is going to be about good enough, and then we can start getting back to normal. Congress, led by Nancy Pelosi, is looking to do a fourth stimulus bill, which really isn't stimulus, it's more relief. It's just a way to try to keep people from going broke and businesses to stay in business while we get through this. And essentially, they are leaning towards basically just paying everybody to stay the heck at home for another month. So my guess is that in May, and probably we'll know in the next 2 to 3 weeks if this bill is out there and passed, but I believe that in May, we're essentially all going to get paid to stay at home. That's great for me. I already work from home. But for the vast majority of the population, it is a shock. Now, I think it ends up being good for society as a whole that we all just stay home from now until around Memorial Day, get things done, do the work we can online, and if everybody's got money in their pocket to make sure that they can pay their bills and start thinking about what kind of pent-up demand they're going to have when this is all over with, I think that's probably the way to go, and I do think that's the way that Congress is starting to lean, especially since people like this are saying we should just have a national stay-at-home order, which is what you've been hearing me say for 3 weeks now, 4 weeks. I've been talking about this since February 27th, right? So February 28th. Dr. Fauci is saying we ought to just have a national stay-at-home order. And you know that President Trump doesn't like the idea. But I think at some point the numbers are going to dictate what he has to do. Now, if this curve bends up at all, he's going to have to do it. If the curve starts to bend down, I'm not sure if he will change anything, but we'll see. I believe, having read a paper from a University of San Diego professor on how these diseases spread and the origins, and we've had diseases like this forever. He ends up just saying that humanity is the most diseased organism on the planet. And we've been able to fight through everything because as we host a virus, if it kills us too fast, it kills itself. So this is a virus that it lives for about a month in a host. We don't know if it goes dormant and stays in us yet. We don't know how the antibodies work, but those tests are coming out. So we are learning a lot about this test, and over the next month, we're going to learn a lot more. I believe it would probably be wise to do the national shutdown idea of Dr. Fauci through about Memorial Day, May 31st. I'm not positive that we would announce it soon enough. And I believe we should do the national lockdown, a week ago, 2 weeks ago, 3 weeks ago, 4 weeks ago, as far back as practical. We should have done it. But every day that we waste is a day that curve potentially goes up, more people die, and the longer that the recovery of the economy is going to take. So I know that we all have friends that still are in denial about this because they don't know anybody yet who has it, or because they don't understand the math behind this. So if anybody doesn't understand the math behind this, I think that Johns Hopkins is making it pretty easy to understand, and the pictures are worth 1,000 words or 1,000,000. The more times that we don't do the things that we need to do, the longer this will take. And unfortunately, I mentioned it last week, we have millennials and Zers throwing coronavirus parties. If you're the parent of one of these people, I believe this is when you should get violent. I don't mean you have to beat the hell out of them, but take away any support that you give to them. Say, you know what? Go live in your car. You can stay in the driveway, but go live in your car. And you get no money. Here's the health insurance card in case you need it. So, we'll throw a bag of food out on the porch for you. That is a significant issue. Another issue is just knuckleheads, walking around coughing. So, we need to put social pressure on the people who are not abiding by the rules that need to be abided by. That all said, let's talk about investments. So last night I put out our chart book. This is the Fundamental Trends website, and I just put this up here because it's easy to read some of the headlines. We've been selling longer dated calls to capture premium and time value. We have a list of a dozen, really it's only 10, and I'm looking for a couple of others, growth stocks that aren't yet in the S&P 500 but should be soon. And that's very good for these companies because not only do they get the run up, but once they get S&P 500 money, that's another bump to their stock price, and it puts somewhat of a floor under their stock price. People were asking when that rally was going on, should I buy, should I buy, should I buy? Told them relax, analyze, and then react. And then finally, we actually started selling covered calls during the rally, faded the rally very well. So anybody who's been selling covered calls the way that I've described a few times has done pretty good. Somebody asked me, why do I keep putting things on the millennials? Because the millennials are screwing up. That's why. Love you, but your generation has got a bunch of hard heads, and I understand that's part of youth and part of the way you came up with running into 9/11 and the financial crisis at the start of your careers. But some of the rock-headed things I hear from millennials as a group, some of the Bernie bros, the people going out with the coronavirus parties, you know what? You need a slap in the head to get into reality. Go read a history book. Go learn some freaking history. Because the lack of respect for experience and knowledge that comes out of the millennials, and I can't quite tell with the Zers yet, is off the charts. You are by far the worst generation for listening to other people without getting a compliment that I've ever experienced and that I've ever read about. Go read The Fourth Turning. You're supposed to be the great generation that's coming up, and you're not fulfilling your place in history. Period. End of story. I hope you fix it. That all said, relax, analyze, react. People were asking, do you want to get involved? We went back to the valuations. Valuations are still high. We're still at a second standard deviation for overvaluation. Valuations matter. You can take a look at this chart, and every time the valuations got really high, we get a recession. Got the rebound, recession, and we're in a recession now. The value of corporate equities versus GDP, this is Warren Buffett's favorite indicator. That was extremely high, and clearly it's coming down now. But we need to get way down to about here for the market to be fairly valued. We're not there yet. This market is still overvalued. So where do we expect the S&P 500 to go? This is the first support line, and I've standardized all the charts. So yellow is your first support line. I believe that, and we've tested it once, I believe that we're going to test it again imminently and probably go through it. The next support line is pretty far down. You can make an argument for there being a line right here. I don't think that this is going to hold, but it could. So we'll just put another yellow line there. Not quite as dark. Oh, that's a crummy line. Let's use orange. All right. So that's that line there, right around 215, 214, 216 on the S&P 500. That'll be another range of support. It's pretty easy to do these support lines. You just got to look where the market has a problem getting through, either to the upside or the downside. And then you stretch things out to find bigger, longer-term support lines. Really all technical analysis, just based on finding where the pivots are going to be. And these areas where the market struggles are good spots to look. And then you can shorten up your ranges, as we've done over and over again, to see what's going to work for the next day or hour or week or month. But the longer term support lines are the most certain. So at about 215 on the S&P 500, the market should, if it's not on an elevator drop, should pause. Will it or will it not? I don't know. The red lines here are other support lines, and normally I only do one red support line, but this is longer and longer term, and this is the broad market. So I'm trying to give you ideas on how far down these levels can go. This area from between the red lines, I think, is the most likely area that we get to, but there is a mega crash scenario. There is a mega market sell-off that could occur. If things get very, very negative, it is not impossible that we go way down to these support levels. See how the market struggled to get through there, went down to it, bounced up, and then went through. Difficult to get back through. Another big correction here. That's the bear market, the dot-com bust. Got back up, struggled for a year, then finally got through, broke through, got back to it, struggled, came back, finally got over. Now the resistance is support again, and we go back up. There's an argument that the S&P 500 goes down to around 115. I don't think so, but maybe. So I've been looking for a spot to sell puts on the S&P 500, and this market has not cooperated. So I was really hoping, as I talked about in the chat room on fundamental trends, I was really hoping that we'd get a green day today. And maybe we'll luck out and the green day will turn green. And if it does, if we get a couple hours where the stock market is green and I can get a decent price on some puts at that 215 level, that's what I'm going to do. And I think I should be able to get those fairly cheap because it's pretty far down. And if I can get them cheap enough, that means that if we get to 215, I should be a little bit better than even. And then if it goes below 215, I start making pretty good money. So really, that's a hedge. If you want to day trade things, this isn't the show for you. I've told you to check out Forex Analytics, or I subscribe to a couple of places that you can ask me about off air. But if you want to day trade, what I will tell you is don't even try it unless you are some sort of a technical god. If you're just going to go out there and learn in this environment, you are insane. Now, you should have been learning a year ago or 2 years ago when it was easy, right? Where the market kept bailing you out of your mistakes. This market's going to be brutal. If we start going through these levels, once again, it'll probably be fast. Over the next, I'd say, through July, August. I mean, this market could be really rough through July and August. I don't think we're going to get this green line. This would be kind of your Armageddon scenario. And I guess, this is the low from the financial crisis. Theoretically, we could get that low. But because we've printed so much money twice now, really 4 or 5 times, but, in 2 groupings, I think this green line, this support level here, if we got down to 120, 115 on the S&P 500, I would probably sell everything I have, live in my car, and invest it in stocks. So, and not this index, right? This is the crippled index that I don't think is ever going to perform as well as it should until they replace about 100 companies. Literally, there's over 100 companies in the S&P 500 that need to be replaced in the next several years. So we'll see. What are the impacts of some of the things that are going on? Corn prices, right? Going down to next to nothing. Soybeans. You go across the list. We're having a big problem with commodities, all commodities. Take a look at oil. We're going to see more farmers go bankrupt. And as I have told you in the past, if you can buy a farm near a city, even if you have to get a group of people to do it and then figure out a smart way of running it, like, hiring the farmer, I think you should kick it around. I think that farmland near cities are going to be developed for subdivisions. I think they're going to be converted into vertical farming, although I think a lot of the vertical farming could actually happen in cities. So we'll see what goes on in the future. But if you can buy farmland, I mean, this applies going back 50 years, right? If you can buy farmland near a city and carry that cost in the short term, you'll do well in the long term. So that is something that I advise everybody. If you can get a group of 2 or 3 or 4 or 5 people and buy a farm and figure out a way to run it in the short term, maybe somebody goes and lives out there and, who works from home, that is a great idea. So I put out our chart book of all the things that we want to invest in. If you are a member of Margin of Safety Investing or Fundamental Trends, you get our chart book. I will just fly through it real quick. All right, there you go. There you see it, now you don't. I would recommend that with the specials I got going on, the half price specials right now, if you're not a member, you should be looking at becoming a member. That chart book, I think, is going to make us a lot of money when we finally get our buy levels. So let's finish off with different commodity. We'll finish off with oil. But in the chart book, I mentioned that we want to split our gold investment between gold and gold mining stocks. And the next day, Invesco comes out and says, hey, you should probably split your gold investments between gold and gold mining stocks. And the reason being is that probably And I'll actually show you this chart. So back when we had the last major gold rally, the price of gold tripled. And actually, it almost quadrupled for a hot minute, right? The gold stocks didn't quite do as well. The reason for that is that they over leveraged and they started mining everywhere they could mine. So as gold came down, the gold stocks got crushed. And now gold has started to turn back up in the last several years, right? We've bought it out in a couple spots. But the gold stocks fell behind. Why did the gold stocks fall behind? Because they still had all these obnoxious expenses. So the gold stocks, the gold companies have spent, gold mining companies have spent 5, 6, 7 years fixing their operations and fixing their balance sheets. At some point, because it cost them around $1,000 an ounce to get gold out of the ground, at some point, as the price of gold goes up, these stocks hit a hockey stick and they have a huge ramp. Why? Because all that profit drops to the bottom line. So a company that's even at 1,000 and making X amount of dollars at $1,500 gold, at $2,000 gold, they've doubled their profit. At $2,500 gold, they've tripled their profit. At $3,000 gold, they've quadrupled their profit. So while the price of gold has only doubled, these companies have quadrupled their profit. So they are very leveraged to rises and falls in the price of gold. So splitting up your gold investment, which I think should be around 15% of your portfolio, that's triple what other people will tell you, between GLD and GDX, I think is a pretty good approach. I believe that Invesco must have some sort of gold investments, but I think these are the two best ones out there. People talk about make sure you have physical gold backing in your ETF, and VanEck Gold Miners ETF is physically backed with gold. Now, does that mean that they have every ounce of gold that they need to back their ETF? No. They got 80, 90% of what they're supposed to have. They fill the rest with futures. So if there was a run and everybody wanted their gold, sure, they'd have a problem. It'll never happen because nobody's going to take delivery of all that gold. So while there is some ebb and flow in the amount of gold they have versus the value of the fund as a percentage, the reality is that it's mostly backed by physical gold, and they fill the rest with futures. So the price of this could skyrocket as well if there's a legitimate shortage in gold. Now, there's some people taking delivery of gold right now, but it's not to the point where you're going to cause a massive spike in the price of gold imminently. But if we got to this mania phase that we got to from about 2010 to 2012, when the price of gold went from around 1,100 to 1,900, you could see a similar move from 1,500 to, I think, pushing 3,000. And I think that's going to happen eventually. I don't know how long it chops along before it hits that, that huge 1 or 2 year run. But when that happens, these gold mining stocks probably have already started trailing along and closing the gap. So I'm going to move towards the position of being roughly 50-50, maybe 8% gold, 8% gold stocks. Right now I'm all gold stocks because I've been writing the calls and they've been rallying. Eventually some of that will get called away from me and I can make my asset allocation shift. If you're just starting with the gold, buy the dips. Buy the dips in gold. Something to keep in mind is that because gold is held up, if we get margin calls because this S&P 500 is going down, then gold will get sold off too, because that is a liquid asset that the brokerages can sell to make up the margin. right, that people lose. So that's why you've seen gold and gold stocks have those big 10% down days, and then it comes back a couple days later. So those days are opportunities to really, really, load up on gold. Just going back to the S&P 500, we're still not oversold on the monthly chart. I think this is the month that takes it down there. All right, so let's finish up with oil. Or not. Let's go back. Let's look at the market just one more second. This is a chart that I grabbed and put out in 2018. And this describes kind of the supply-demand equation for the stock market. You have buy orders from whoever the marginal buyers are. Mom and Pa is the last one, but you have institutions and you have foreigners. Institutions aren't buying right now. Foreigners aren't buying right now. There's some people out there that still think this is a buying opportunity and not a value trap. They're buying, but they're drying up. The market's down again today. The sell pressure, I think, is going to accelerate as the month goes on, and the last retirement plan dollars are coming into the market right now. The retirement plan dollars will be gone. That's part of the seasonal effect of the first quarter very soon. So there's going to be a lot of selling pressure with almost no upward buying pressure in just weeks. So here's that big support level that I talked about way back at the start of 2018. Coincides with between these red lines. Again, the whole delusion thing. Right, we had the discussion with Mark Yusko back in 2017. Market has done almost everything that I've said it would do. Not exact orders, not exact magnitudes, but pretty close. Like I said, the only thing I've really screwed up is the oil trade. That's why we're going to finish with oil. So where are we on this big chart? I believe that we had the rally here, and now we're getting over the hump. And how far down this represents, again, it depends on just how badly we handle beating down coronavirus. The worse this curve looks, the more this curve bends up, the more the stock market goes down. It's that simple. So we need to beat this over. This needs to get beaten over, or we're in a world of hurt, because we will see the first red line and then the second red line, and maybe this. We'll see. And that's why I don't want anybody to rush right into the stock market right now, because unless you have a really good idea about a company and you really truly have done the work and you understand everything about a company, you shouldn't be jumping in right now. And I know there's articles on Seeking Alpha and other places saying, oh, it's going to all come back faster than people are saying. It's not. The people saying that are naive. They're not real economists. They're not really good investors. They're the types of people who just kind of follow along and they ebb and flow. So that is something that you have to be aware of, is that you have CEOs coming on right now saying that this is the biggest economic shock of their entire careers. And most of these guys worked in the last two. So this is worse than the financial crisis. It's faster moving and deeper. Now, will we come out of it as fast? I think it'll be similar. I think it'll take a couple of years. So should we expect the economy to be back to normal by the end of this year? No. Early next year? No. Summer of 2021? Maybe. But probably not quite. It probably takes until the summer of 2022 after everybody's immunized and feels confident that they're not going to get anything, I think it's going to legitimately take about 2 to 2.25 years, the summer of 2022, before the economy really ramps up. Now, that doesn't mean it's going to take that long for the stock market. The stock market will anticipate things. It'll see what's coming. And people will start buying for tomorrow. When will people start buying for tomorrow? Well, they haven't started selling for today yet. The correction we've had has been a minor correction. You may not feel like it's a minor correction, but this has been a minor correction because it's barely taken us off of the super overvalued level that we were at. All right. So let's finish off with oil. This is a tweet that I sent out today. The big skim by shale oil companies is just about done. First they borrowed, then they bonused their executives, then they borrowed, then they bonused their executives, then they went broke a few years ago, and they borrowed more, and they bonused their executives again. And now they want to bail out. Why? So they can take the companies private, steal the assets from the shareholders, and then bonus themselves again. If you own oil stocks, you should be looking for a way to get the hell out. Because they've been screwing you all along. I know, I got screwed. And they're going to screw you again. They're going to take most of the companies private. Will the majors go private? No. They're going to have to break up to save their souls. But the shale companies, with 1 or 2 or 3 exceptions, they're going bankrupt or they're going private. I guess there may be a dozen that survive. But I want you to understand where oil is going. This is as big as I can make this, but I will have it in an article soon. The price of oil is going to stay under $40 a barrel for a couple of years. Why? Because the supply and demand is that far out of whack. We're going to have about a 16 million barrel a day build in inventories over the next few months. It's actually happening right now. So the build started in the last several weeks, so it's not really quarterly. This is broken down quarterly. Really from March through whenever we start driving again, probably July. So March, April, May, and June, probably going to have builds of 16 million barrels a day of oil. This idea that you're going to see an oil cut of 10 to 15 million barrels a day, not a chance in hell. Not a chance in hell. First of all, the Russians can't do it. The Russians aren't drilling very much to begin with, and they're not going to cap wells because that costs them money. You get some inventory that's depleted. The Russians can only lower, and they tried to do it with their OPEC Plus deal, but the Russians can only really cut their production by 1 to 2 million barrels a day just because of the way their infrastructure is built. Saudi Arabia, maybe you get another 1 to 2 million barrels a day out of them, another 1 to 2 million barrels a day out of the rest of OPEC, and then our shale companies. Do you think our shale companies are going to cut their production by 1 to 2 million barrels a day like automatically? No. They're going to have to go bankrupt before they do it. They've been screwing everybody by overproducing for several years now. When they had that first oil bust 4 or 5 years ago, they should not have ramped production back up. When it dropped by that million barrels a day, they should have left it there. But they ramped it back up and set new records. Why? Because they're greedy. And their model for making money as an executive was based on how much production, not how much profit. The shareholders who were losing money there basically got swindled, but at a certain level, we didn't see what was coming, and that's on us. But any shareholder in oil, I'd say in the last year, probably is probably complicit. right? I wrote that article about why oil prices are priced for Armageddon a year ago. The overproduction, the divestiture movement, everything, fewer miles driven, everything across the board, all the things conspiring against oil. And it took me until early this year to throw in the towel on my last couple of stocks. I don't care if they survive. And in fact, it saved me a ton of money because they all dropped over 50% since I sold. You're not going to make your money back in oil stocks if you own them. And you're going to have to just figure out a spot where you can sell and then redeploy what money you have left. If you can get 20, 25, 30, 35% of your money back, that's pretty damn good. Why? Huge oil glut, getting bigger by the minute. And I have factored in cuts, right? I have factored in cuts and bankruptcies. And I believe that at some point here, we'll run a slight, in about 2 years, again, starting with summer 2022 is what I'm pegging. Demand will slightly outpace supply for a little while. But as we get to the middle 2020s, all of the car companies are saying 2025, that's the year that they have all their EV models. And 2026 is the year they start getting rid of ICE models. So demand and supply will be on this plateau that I've been forecasting for 6 years now, since February of 2014, or excuse me, June of 2014. I may have used it a little bit earlier. And then by the early 2030s, demand for oil will fall faster than supply for oil. And we'll get huge inventory builds and the price will go down again. And why will this happen? Because there is certain oil, conventional in nature and deep water in nature, that can't come offline that fast. They'll stop investing in it, but the demand will still fall faster than the supply. So, give you another piece of advice. Unless you are just absolutely against owning a gasoline-powered car and you want an EV as soon as possible, what I'm thinking about doing is we'll have our EV for driving around the city, but I'm probably going to still have a SUV for when I want to go on a long trip. And you know what? I'm not going to have to pay a lot for the gasoline, unless in the next few years they decide to tax it. So I've got a 4Runner that I get 5 more years out of. So in the next 5 years, before 2025, as we get up to here in the middle of the decade, 2025, 2026, when they start closing out and getting rid of all their ICE inventory, I'll have to make a decision. Is gasoline going to be cheap enough for me with the price of oil going down? Or are they going to tax the heck out of gasoline? We'll see. I don't know. But that'll be a game time decision, like a lot of things. I don't think you should be betting on oil prices going up, even though they probably get to 40 in the next couple of years. Again, you better be a godlike technical trader and day trader to do that. You have to compete with people like this. She's an amazing trader. And there's, like I said, the people at Forex Analytics that I interview with once in a while. You are just up against a world of professional traders and machines if you're going to try to day trade. So be very careful about that. Swing trading, you're starting to play against the public. That we can win. But day trading, you better be a superstar. And I'm not saying that some of you couldn't be, but if you aren't yet, you got a lot of catching up to do. I will take just a couple of questions. Let me scroll through the chat real quick. I don't think there might be a farm REIT out there. I don't really know. We talked about puts on the S&P. I have some positions in USO and DBO, but I'm looking to close them. I should be able to get a small profit. Somebody's talking about a friend of theirs that has COVID. Yeah, that's tough. There are discussions around shutting oil fields in the Gulf of Mexico. Yeah, but they have to open them eventually. Otherwise, those companies lose money forever, right? You're going to see more storage for oil built. And China's building it quickly, right? Because that's what they do. China's been the real only buyer here for oil, and they're storing as much as they can and on ships and building new tanks. You know, they're sticking it everywhere they can stick it and building more. So think about that. If this huge supply of oil ends up a lot of it in China, and they're the ones that accounted for 70 to 80% of the increase in use of oil, but they're also the ones converting all their diesel buses and trucks to electric and taxis, and they're pushing EVs real hard. How long, you know? I mean, I'm saying in my chart, oh, I closed it, darn. In my chart, I said that demand for oil would peak at about 102 million barrels a day. It was up about 101.5 recently. 100.5 recently. So this idea that we have a lot more oil demand growth coming, completely wrong. We'll get a little growth through the middle of the decade, and that's it. That's it. Oil demand growth is going to turn over even sooner than I thought. And people thought I was crazy a couple of years ago when I said 2030 would be the peak in oil demand. I think the peak in oil demand is going to be 2025. 26, 24, 25, 26. At about 102 million barrels a day. So just a little bit higher than what it was several months ago. So if you're a member of Fundamental Trends or Margin of Safety Investing, the chart books are right where all the articles always are, either on latest articles in Margin of Safety Investing or on the front page or the investing section of Fundamental Trends. That's where they always are, never move. The thing with tanker companies, somebody asked about, is they're getting a pop right now. But as that oil comes off the ships, just go take a look at their charts. Again, you can trade them. You don't want to own them for very long. Everybody asks about pipelines. I don't like oil pipelines because I do think they're going to take some hits from their customers. But I like the gas pipelines. Interesting thing about gas is as oil drilling subsides, price of natural gas will go up. Why? Less associated gas with the oil drilling. So that's something to keep in mind. Kinder Morgan is the only pipeline company I own. I've gone through all the reasons why, the buybacks, the likelihood of a strategic transaction, the dividends increasing, Kinder buying all the shares, which is the tip-off that he's going to sell it at some point. Kinder Morgan is the only one I think you need. I don't like EPD. I don't like ET. I don't like any of them. You know, take a look at the problems they're having repairing their oil pipelines. States don't want them to even repair them. They just want them shut down. We got two of them near me. And they're trying to repair them, and the states are saying, no, move it, and don't move it here. So they're running into NIMBY. Yeah, the oil pipelines, stay away from. There's very few that are worthwhile. You know, I mean, any pop that you get in almost anything fossil fuel related, you ought to be selling. The exception is if you can identify natural gas stocks, companies that will stay in business, maybe they do well in a few years. I don't know that I want to play that game. I think it's too hard. I think there's much easier things to invest in. They have much more certain futures. So, again, I've always thought that natural gas was the better play than oil. But for the last several years, everybody said oil, oil, oil. And now we're finding out that they were wrong or they were lying. I think it's both, and stealing. So there you have that. All right, let's shut it down here. We got one done in under 45 minutes. I think that is great. Everybody have a great weekend, and I will see you on Tuesday night. Members of really anybody, fundamental trends or margin of safety, you can come to the Tuesday night webinar, which is all stock based. I will have the stock chart list books, all three of them. I'll have 3 stock chart books out, probably before the open on Monday, but possibly it might be Monday night. We'll see, but sometime Monday. And I'll have my quarterly outlook out as well soon. Take care.